Did you commit to another CPA review course that just isn't aligned with how you learn? Well, spilled milk, baby. In the world of accounting, only one figure matters, and that's the bottom line. So by investing in Universal CPA Review, you're investing in yourself, and we promise to do everything in our power to get you the ROI that you're looking for by obtaining your CPA license. We know that purchasing a CPA review course is an investment, and we also know that spending all that money on a program that hasn't worked out sucks, and we want to soften that blow. Our Spilled Milk program will allow you to commit to Universal's Visual Learning CPA Review program at a steep discount. So reach out to info@universalcpareview.com to learn more about our program and what discounts you qualify for. Okay, people, we're now going to dive into the next important topic that should be understood for your exam. Okay, so back in the day, we used to refer to the revenue recognition standards for long-term contracts with very specific terminology. And although that terminology has more or less changed, the methodology hasn't. Okay, so the bottom line is that the CPA exam is still testing both the percentage of completion method and the completed contract method for long-term construction projects. Okay, so it's important that you know the differences between the rules and the standards for both of these methods. So companies can normally recognize revenue at the point of sale, right? Heather's clothing store recognizes revenue when she sells clothes to customers. Whereas Bo's Building Corp has sourced revenue from building skyscrapers that might take multiple periods to get done, right? There isn't one simple transaction like there would be at Heather's clothing store. Let's say it takes 3 years for Bo to build up the skyscrapers. So the question becomes, how does Bo recognize revenue from these more long-term construction contracts? Okay, so the general rule is that revenue is getting recognized when it is realized or realizable and when it is earned. And what you need to know is that there are 2 ways for Bo to recognize revenue. We can use the completed contract method or the percentage of completion method. Okay, so the completed contract method is going to recognize revenue at the completion of the contract, whereas the percentage of completion method is going to recognize revenue throughout the contract. Okay, so for CPA exam purposes, the completed contract method is much more simplified than the percentage of completion method. So companies will recognize the completed contract method when any of the following conditions exist. All we need to do is meet one of these conditions. Okay, so the company is primarily short-term contracts. The company can't meet any of the conditions that are used for the percentage of completion method, right? AKA, we cannot recognize this contract throughout the life of it, or there aren't inherent risk hazards in the contract beyond the normal recurring business risks. Okay, but when it comes to the percentage of completion method, as we said, we're going to be recognizing revenue throughout the contract. So in this case, we're saying that revenue is getting recognized before the delivery of the completed contract. So this is arguably the more important method for recognizing long-term contracts. This is much more comprehensive, and the exam is known to test your understanding of it. So the percentage of completion method must be used when estimates of progress towards completion, revenues, and costs are all reasonably dependable, and if all of the following conditions exist, right? So all of these have to exist. The contract clearly specifies the enforceable rights regarding the goods or services by any party involved. They need to specify the consideration that is being exchanged and the manner and the terms of the settlement. The buyer can be expected to satisfy all obligations, and the contractor can be expected to perform under the contractual obligations. Okay, so that's a high-level overview of both methods. Now let's drill into the details. Alrighty, let's start by breaking out the more simple method of recognizing revenue for long-term contracts, and that's the completed contract method. Okay, so this is only a US GAAP reporting standard. Okay, so under this standard, we're recognizing revenue at the completion date of the contract. So Bo is conducting a construction project to construct this skyscraper, and it's going to take the company 3 years to construct. Well, then revenue is not getting recognized until year 3, and that's going to be when the project is completed. All right, so as we mentioned, this is going to be used when we can't recognize revenue using the percentage of completion method. In other words, when we can't recognize revenue throughout the life of the project for whatever reason. So at the date the contract is completed, we're going to recognize gross profit. Now keep in mind, if for whatever reason there's a loss, that is going to get recognized when the loss actually occurred. Okay, so if we have a 3-year contract and we determine that a loss occurred in year 2, then we're going to go ahead and recognize that loss in year 2. So super simple formula when it comes to the completed contract method. we're going to take the total contract price and reduce it by our total costs to determine our gross profit or loss. All right, but with that being said, we also have some balance sheet accounts that are getting impacted here as well. So the two big accounts that might sound unfamiliar for normal GAAP reporting standards are specific to long-term contracts and will be accounted for when recognizing revenue using both the completed contract method and the percentage of completion method. And that's going to consist of what we call construction in progress and progress billings. Okay, so the construction in progress account is an inventory account, whereas progress billings is a contra inventory account. At the end of the day, they both tie out, and if there is a discrepancy between these two accounts, then we're going to recognize them as either a current asset or a current liability. Okay, so for now, what you need to know is if the cost of the project is greater than the total amount billed, then we're going to recognize a current asset. And if the amount that we have billed on the project is greater than the total cost, then we're going to recognize a current liability. So let's be familiar with that for now, but we'll break this out a little bit further when we get into the percentage of completion method. All right, so now that we understand at a conceptual level what the fundamental differences are between the completed contract method and the percentage of completion method, we can now address how to report this in the financial statements. So the primary journal entry that you need to be familiar with when it comes to the percentage of completion method is going to be how to report revenue and construction expenses. Okay, so remember, revenue is getting recognized throughout the life of the project when we're dealing with the percentage of completion method. But also keep in mind that in a situation where a loss has incurred, then this is going to get recognized again in the year that the loss has been incurred from construction. Okay, so at the end of the day, that's what impacts the income statement. And that is arguably the more complicated financial reporting impact that we need to understand. But with that being said, when there is something that impacts the income statement, there's also generally going to be an impact to the balance sheet. And this situation is going to be no different. All right, so let's go through some of the different balance sheet impacts when it comes to the percentage of completion method. Okay, so we have our construction in progress account and our progress billings account. So essentially, our construction in progress account is our inventory account, whereas our progress billings account is sort of this contra inventory account. So as we mentioned, at the end of the day, the construction in progress should equal our progress billings. So two very important accounts that go hand in hand here. And again, can't stress this enough. The percentage of completion method is going to recognize revenue as the project is completed. And progress billings represent how much Bose Construction Company is billing the client as the work is getting done. Right, at the end of the day, these two accounts should tie out. And if there's a difference between the two, it's either going to get recognized as a current asset or a current liability. Okay, so the total amount of the cost to date can either be in excess of progress billings, or the total progress billings can be greater than the total costs incurred to date. So how are we going to recognize revenue? Based on the cost to complete the contract, right? Under the percentage of completion method, we're recognizing this as the contract is getting completed, right? Throughout the life of the project. So when costs are greater than the progress billings, basically this means that we have more cost and therefore we have earned more than we have billed. And that's what makes this an asset. Okay, so this is unbilled revenue. So if cost is greater than the amount that we have in progress billings, then this will be reported as a current asset. Okay, so we also have an account referred to as due on account receivable. So this basically means that we have billed more than we have collected, right? Just because Bose Construction Company has billed for the work that they have done doesn't mean that they have collected all of this. So this becomes a current asset. You could think of it this way. Any uncollected amount that remains as a billed amount outstanding is the same concept as an account receivable, right? The revenue has been earned, we just did so on credit. So it hasn't been collected yet. Whereas on the contrary, if progress billings are greater than the total accumulated costs, we're going to have a current liability. Now we're saying that we have billed the client for the work that we haven't done yet. So this is technically unearned. So in this case, that would be recognized as a current liability. Okay, so as we said, two different methods when it comes to recognizing contract revenue. We have the completed contract method and the percentage of completion method. All right, so that completed contract method will essentially recognize revenue from a contract at the completion of that project. But if we are applying what's referred to as the percentage of completion method, we're going to be recognizing the revenue throughout the project. Okay, so it's going to get recognized as the project is getting completed. And there are 4 primary steps that we need to go through in order to not only understand the intuition behind why we're recognizing revenue in this way, but also so that we can be as prepared as possible for what they're likely going to throw your way related to this topic come exam day. Okay, so the percentage of completion method is what they have been known to test more than the completed contract method, but we should still be familiar with both. Okay, so we're going to go through our 4 steps within our mental map when it comes to the percentage of completion method. At the end of the day, the name of the game here is being prepared for our step 4 journal entry. All right, where candidates love to get tripped up is knowing how to recognize revenue and expenses within the percentage of completion method. All right, but again, that's step 4. So in determining step 1, we're going to determine the annual percentage completed. All right, so this percentage is going to be super important to calculate. So much of our calculation is going to be based on this percentage completed, right? Because the reality is, under the percentage of completion method, we're going to be recognizing revenue as the project is getting completed. So it makes sense that we understand what portion of the project is complete, as this is what recorded revenue is based off of. Okay, so we're going to calculate the cost that has been incurred to date. So we're going to take all of the costs that are incurred in year 1, and we're going to divide it by the total estimated costs. Right, at the beginning of the project, we're going to estimate how much we think this is going to cost in total. And that cost can fluctuate every year, right? Things are going to change. Maybe we think it's going to cost more in the following year, maybe less. But point being is that it's possible that there's a different denominator in this calculation. Right, so bottom line is that estimated total cost figure can change each year. All right, but the calculation itself is going to remain the same. And keep in mind that the numerator is the cost incurred to date. Meaning if we are determining year 2 costs incurred to date, we're not only going to include the costs incurred for year 2, but also the costs that have been incurred in year 1, right? This is everything up to this point divided by the total estimated amount. And we got to ask ourselves, why is this even important? Because we're going to use this percentage to calculate our gross profit going forward. Step 2 is focused on gross profit. Okay, so we're determining the annual gross profit recognized. So we're going to go ahead and break this out into steps 2.1 and 2.2. Step 2.1 is going to simply just determine the gross profit, and we're going to do this each year. So each year we're going to take the total revenue figure, right? Let's say that Bose Construction Company bids a certain amount on this project and they get the gig. This is how much they're going to charge for that construction. Okay, so this is the total revenue that they're earning. And that's going to be reduced by the total estimated cost each year. Okay, so that's how we calculate our gross profit for the purposes of the percentage of completion method. But again, that's step 2.1. Now in step 2.2, we're going to take that gross profit for each year and we're going to multiply it by the percent completed, right? That's the annual percentage that we calculated in step 1. So why is this important? Well, this is ultimately going to be what is used to calculate our construction in progress. So what is construction in progress, you ask? So this is ultimately an inventory account. This is where all of our construction costs and all of our estimated gross profits are going to be accumulated. Okay, so super important that we know how to calculate this, because when it comes down to recognizing revenue and construction expenses, which is arguably going to be the most important journal entry that you need to know, it can be a little bit tricky. So this is how it's done. We're going to take the current year gross profit, right, that gross profit figure that we're calculating each year throughout the life of this project, and we're going to reduce it by the prior year gross profit. So when it comes to recognizing revenue and construction expenses, this is going to be the plug figure. Alrighty, so super important that we know this calculation. All right, at the end of the day, step 4, knowing the revenue and expense journal entry, is ultimately what they're going to ask. Right, super important that we know the journal entry. Okay, booyah, let's go through an example. So Bose Construction Company is a GAAP reporting company, and the company enters into a 3-year contract to build a new skyscraper at the beginning of year 1. So we have all this information for year 1, year 2, and year 3. We're going to use this information to determine the costs incurred for years 1 through 3. We're going to record billings on the contract. We're going to record payments received, and we're going to record revenue and costs during the construction period. Okay, so when attacking the percentage of completion method, we got to go through our 4 steps. So step 1 is determining the annual percentage completed. This is the most important percentage that we're calculating when it comes to the percentage of completion. right? Ultimately, we're recognizing our gross profit based on the amount of this project that we're completing, right? The whole idea of the percentage of completion method and where this is different from the completed contract method is that we're recognizing revenue throughout the life of the contract, right? It's getting recognized as we're completing it. So we're taking the total cost incurred to date and we're dividing it by the total estimated costs. Okay, so again, this is on an annual basis. So in year one, we're taking $7 million, which is the total cost incurred to date, and we're dividing it by 21 million. Okay, so the total amount completed at the end of year one is 33%. All right, whereas in year two, we're now saying that the total cost incurred to date is 12 million. But keep in mind, this 12 million also includes the amount that we've recognized from year one. So the 7 million is within this $12 million amount. All right, but bottom line is we're taking the total cost incurred to date. So 12 million is getting divided by the total estimated costs. So in year two, we're now saying that the total estimated cost is 24 million, right? Maybe Bo decided, well, this is going to end up costing more than we originally thought, right? Maybe the cost of raw materials are going up. Maybe the cost of labor is going up. Regardless, we're going from 21 million to 24 million. So this is now the denominator when calculating the year two percentage. So at the end of year two, 50% of this project has now been completed. And in year three, we see that we had 24 million as our total cost incurred to date, and the total estimated cost is 24 million, right? We wrapped up the project. 100% of it is complete. So we now know our annual percentage of completion figures. Okay, so let's hang on to these. Now in step 2 of our mental map, we're going to determine the current year gross profit. And this is broken out into steps 2.1 and 2.2. In 2.1, we're going to determine the current year gross profit. All right, so we're going to take the total revenue amount and we're going to reduce it by the total estimated cost. In year 1, we have total revenue of 30 million, right? This is the total amount we expect to make from constructing this skyscraper. Total estimated cost in year 1, we remember, was 21 million. Okay, so the gross profit amount was 9 million. In year 2, we're taking 30 million, we're reducing it by the new total estimated cost of 24 million. Gross profit is 6 million for year 2. Same goes for year 3. Okay, so 30 million, once again, reduced by 24 million, gives us gross profit of 6 million in year 3. Boom, now we can move on into step 2.2. What percentage are we going to use? We said it, we're going to use the percentage that is complete, right? We determined that in step 1. So we're going to now take that gross profit that we have determined for the current year, and we're going to multiply it by its respective percentage amount. Okay, so the current year gross profit for year 1 is 9 million multiplied by 33%. That's going to give us a current year gross profit of 3 million. In year 2, we're taking the $6 million figure, and we're now multiplying it by the year 2 percentage. Okay, so 6 million multiplied by 50%. That's going to give us another 3 million. In year 3, we're going to multiply 6 million by 100%. That's going to give us 6 million. Okay, so now determining step 3, which is arguably our most important step. We're going to determine the total construction in progress. Basically, this is going to be our plug figure when it comes to the revenue and expense recognition journal entry. All right, so hang with me. So we have our current year gross profit of 3 million for year 1, and we're going to reduce this by our prior year gross profit. Okay, so our construction in progress is going to be $3 million for year 1. In year 2, we're taking the 3 million from the current year, and we're going to reduce it by the 3 million from last year. So what's our construction in progress for year 2? It's going to be 0. And when it comes to year 3, we're going to take the $6 million amount, and we're going to reduce it by the prior year gross profit of 3 million. Okay, so the construction in progress for year 3 is going to be another 3 million. Okay, so let's skip down and go through our revenue and expense journal entries, right? They're asking us to calculate this as well. Then we'll come back to the first 3. Okay, so for year 1, we're going to start by debiting our construction expense. All right, we're always going to debit construction expense and we're going to credit our construction revenue. Construction expense is the total amount of cost incurred to date as of year 1. Okay, so the total cost incurred to date in year 1 is 7 million. What about the total construction revenue? So again, we're focused on the completed contract percentage. Okay, so the percentage complete at the end of year 1 is 33%. This amount multiplied by our total revenue is going to give us the total amount of revenue that is recognized for year 1. Okay, so 10 million is getting recognized in year 1. All right, and our plug figure is going to be the debit to construction in progress. Okay, so as we mentioned, construction in progress is our inventory account. Okay, so this is going to be our plug figure from step 3. Another way to think about this is the gross profit that is recognized for year 1. The current year gross profit less the prior year gross profit. So 3 million should always be that amount, and that's going to be our plug figure. That's why step 3 is oh so important. Step 2, same story. We're taking the construction expense, which is going to be the total cost incurred, but as of year 2, right? If we recognize the 7 million from year 1, we'd be double counting. So we've incurred a total of 12 million, but we already recognized 7 million. So the total expense for year 2 is going to be 5 million. So when it comes to revenue, again, we're going to be recognizing the total revenue amount for year 2 only, meaning we need to back out revenue that was recognized from year 1. All right, so we're recognizing a total of 50% of 30 million, right? 15 million is getting recognized in the current year. But we already recognized 10 million last year. So 5 million is getting recognized as revenue for year 2. So do we have a plug figure? Well, nothing is going to be the difference between 5 million and 5 million. And if we look back in our step 3, our construction in progress that we calculated, the answer was 0, right? Current year gross profit minus the prior year gross profit is 3 million minus 3 million. All right, so we wouldn't have a construction in progress account for this specific year. And now finally for year 3, we're going to take that construction expense yet again. But again, this is the construction expense for year 3 only. All right, so it's 24 million, right? That's the total cost incurred to date. But we've already recognized 12 million from year 1 and year 2. So 12 million is getting recognized for this year. All right, so when it comes to revenue, once again, we have already recognized 15 million. We have 30 million times the 100%, which is obviously 30 million, but we're backing out the previously recognized 15 million. So that $15 million difference is going to be what is credited to construction revenue. So now finally, our debit to construction in progress is going to be that $3 million plug figure. And if we look back in step 3, that is yet again what we calculated. Okay, so quickly running through our miscellaneous journal entries, right? So the journal entry for cost incurred. Okay, so that's going to be the total cost incurred to date for each of the 3 years. But what are we going to record? So this debit account is going to be to construction in progress. In year 1, we had $7 million of cost incurred. So we're going to have a debit to construction in progress and a credit to cash, or if this was paid on credit, to a payable. Okay, so same story in year 2. Only in this case, we're going to incur 5 million as of year 2. All right, so a debit to construction in progress for 5 million, and we're going to credit cash or that payable again for 5 million. And the remaining 12 million is recognized in year 3. Okay, so same journal entries, construction in progress for 12 million, and the credit to cash or the payable for the remaining 12 million. So what are we recording for the billing, right? Billings are different from the cash that is actually collected. This is the amount that we're billing the client or the customer. All right, so most important takeaway here is that the billing figure is going to always be a debit to contracts receivable. All right, and the credit is going to be to progress billings. So we billed $10 million each year. How much did the company collect? All right, so this is going to be our 3rd journal entry. So how much of the billing are we collecting from this invoice submitted? So we're going to have a debit to cash. This is the amount coming in, and we're going to have a credit to the contracts receivable. Right? The contracts receivable were debited when we billed it. We're going to reverse that account out when we collect on it. Okay, so we have a debit to cash and a credit to contracts receivable. Okay, so in year 1, that amount was 8 million. In year 2, 12 million. And year 3, 10 million. Okay, so at the end of the day, that's how it's done. But most important takeaway is going to be to focus on how we record revenue and how we record the cost during the construction period. That is what we are determining in our step 1 through step 4 mental map.